Good morning and welcome to this Monday, September 26th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, we're going to start off this week with the final day of this historically bearish period. I follow history, and the July 17th close through the September 26th close is the worst historical period. And I usually bring that up when folks start talking about going away in May, because for me, May and June still provide a number of historical periods that are pretty bullish. But once you get to July 17th, the middle of July, through the latter part of September, that's when we hit what I consider to be the roughest period for the stock market. So that period does end today. Doesn't mean the weakness we've been seeing will end, but it does mean that one indicator will flip, turning a little bit more bullish as we go into October, and then a lot more bullish at the end of October. I think it's October 27th at the close. I wrote about this, by the way, in today's EB Digest. So if you are an EB Digest subscriber, then you should have a little bit more information on that, what we might be able to expect, at least based on history. This doesn't mean that's what happens every year, but there are tendencies I think are definitely worth following. Taking a look at futures this morning, because it does look like we're going to be under some pressure getting started this final day. We are off our earlier lows, which is good. But right now I'm showing, and this is probably as of about 10 minutes ago, Dow futures were up, or excuse me, down 66. S&P futures were down 10, NASDAQ futures down 4. The 10-year Treasury yield up 5 basis points to 3.75%. So another new high. Crude oil prices are relatively flat. I don't know if you noticed, but at the end of last week, they closed down below $80 a barrel, finishing right around the $79 level. So there's a lot of stuff going on. It seems to me, based on everything I'm seeing, that based on the way I'm interpreting the charts, that the Fed is adamant about throwing us into a recession, even if you believe we're not already in one. I believe we're already in one, so I just think it's going to get worse. But that seems to be, the strategy that the Fed is taking. They want to essentially kill demand, or at least weaken it enough so that inflation is no longer a problem. They believe that's the strategy to squash out inflation. I've got my own feelings about that, as many of you know, but I think that they're probably going a little bit too far. And so, and it's kind of reflected in some of the areas. We'll take a look a little bit later at transportation, but transportation stocks, even though we've just come back down to where we were in mid-June, so we got a double bottom in play, transportation stocks have broken down. So anyway, we're going to take a look at that in just a minute. What I'll do first to get things started here is take everyone over to earningsbeats.com. This is especially important for those of you that are new to the program. If you go to earningsbeats.com and you scroll down, there's an area where you can subscribe to our EB Digest. That's what I was just referring to. So one of the, we talk about a lot of different things, but history and historical tendencies are certainly one area that we focus on in trying to educate folks on our EB Digest about how the market works. This comes out 3 times a week, Mondays, Wednesdays, Fridays. Normally it's out by about 8:30. We're a little bit late this morning. That was my fault. But normally Monday, Wednesday, Friday out by about 8:30. All you need is your name, email address, hit that subscribe button. There's no credit card required. You can unsubscribe at any time. Most of the time it's a very quick read. So don't think that, hey, 3 times a week I'm gonna be reading this long newsletter. It's literally 2 paragraphs in a chart normally. If it takes you more than 2 or 3 minutes to get through it, you're probably distracted. I mean, it's a very, very quick read. Anyhow, go over to earningsbeats.com, scroll down, make sure you subscribe there. One other thing that actually is kind of interesting, I think, too, is if you go in and look at our historical performance, you can see that this quarter, even though we're not having a great quarter, we are outperforming the S&P 500, and we're doing it with growth stocks. We got a little bit more aggressive, actually quite a bit more aggressive this quarter. And this quarter, by the way, started back on August 19th, almost right at the high. August, I think 16th was the high. So almost right at the high, we fill up our portfolios with mostly growth stocks, and they're outperforming the S&P 500, which I think is maybe a little bit of a telltale sign. Those of you who've been with us for a while, I mean, it was really difficult when the market was worried about inflation. The periods when we were more heavily into growth stocks, we got hit very hard because inflation worries will impact growth stocks more so than value stocks. So I just find this interesting that over this past month, all three of our portfolios have outperformed the S&P 500 when we're carrying growth stocks and everybody's worried about inflation. And that's part of what we're going to talk about too here in just a couple of minutes. But I do want to start off with the market recap from Friday because it was not a good day. Well, it was good in one sense. Obviously, the negative action is not good. Dow Jones Industrial Average down 486 points, almost 500 points. And you can see the Dow did close below that June low. So, I mean, while I would still say that's at this point like a double bottom, I think it'd be more of a breakdown if we get the other major indices to follow suit. Right now, we have the Dow and we have the small caps, which both closed. I believe small caps closed just below that June low. Mid caps above, NASDAQ above, S&P 500 above. So if they all five go, then to me, it's a little bit more of a technical breakdown. All of them right now are just hovering right there near that June low. We'll see whether or not they hold. Clearly, if they don't, it's much, much more bearish technically. So we do want to watch this level and see how we open up this week. As I mentioned earlier, today is the last day of the historical bearish period in the summertime. We'll see whether or not that matters. S&P down 64. The one piece of good news I'll say here is that our low close back in June was 36.66, and we got down to 36.47 before coming back and closing at 36.93. So intraday, we went down beneath that support level, but we held at the close. And if we can somehow negotiate these first couple of days and even begin maybe to put in a higher high and start to at least get a little bit of strength going here, maybe this is it. Maybe this holds. We'll see. NASDAQ down 199 points on a percentage basis, a little bit worse than the S&P and the Dow, but we did hold the June low there. Mid caps down 49, small caps down 25. Moving on to the sectors, energy was the weakest group, down 7%. Like I mentioned earlier, crude oil prices down below $80. I think that spooked a lot of energy traders, and we had a pretty significant breakdown in energy. This looks like, 70 is obviously a key short-term support. We held it back here. That was in April, then again in late June. Then when we finally broke down below, when we went back up, we gapped up right about the 70. You can see this pullback here in July was at 70, August was at 70, and now here we are again at 70. So 70's held quite a bit. This looks a little bit to me like the S&P 500 when it was at 3,900. So right back up in here, you can see all these tests around 3,900. And then ultimately when that was lost, we went down and we tested that June low. So be careful with energy. If the Fed is really adamant on lowering demand, and we're already seeing global demand deteriorate everywhere, it's going to be hard, I think, for energy to remain at 70, the XLE. I would think crude oil continues to drop, and we see the energy group go back and at least challenge the 65 area. Discretionary weak. Discretionary has been a very good area on a relative basis, but last part of the end of last week, not so great. 3 down days in a row. We did fail to hold on to the early September support area. We did that on Thursday, and then we just added on to the weakness on Friday. But we have a little bit of room to get back down to that June low. Material stocks really have been weak. Those who are counting on inflation, you would think materials held up really well through about April. They were a relative leader. And since then, it's like Wall Street has been saying, we're not worried about inflation. Hence, materials taking a big hit. I don't have real estate up here, but check out real estate breaking down beneath the June lows. Real estate is a hedge. Gold is a hedge. Gold has broken down beneath the June lows. Gold's at a 2.5-year low. So the way the market's operating, what I'm seeing on the charts is not telling me that we should be worried about inflation. Now, to be fair, that's what they've been telling me for a while, and the market has gone back down to where we were in June, and we've got the Fed still adamant about raising rates. They're not raising rates because of our strength in the economy. You know, in my opinion, they're raising rates for all the wrong reasons, which is inflation. I mean, generally we're okay with rates going up, especially when they're this low, because normally rates go up with a strengthening economy. That's when rates are going up for all the right reasons. When rates are going up because of inflationary concerns, that is not a good reason for rates to go up. I mean, it's good to fight inflation. I'm just saying, when a lot of times when I see rates going up, normally the S&P 500 goes up with it. Because again, if it's strengthening economy, that's good for the S&P, especially if rates are still low. But when rates are going up because of inflation, that's generally not a good thing for the S&P. Materials, as I said, broke down below that June, July low. Don't really like that group. Communication services continues to be the weakest area in the market, especially among the aggressive areas. So communication services weak, and then industrials down, testing the June and July low. So essentially we're back down to that low, and I'll show you on a chart in just a little bit what that could mean. I mean, obviously the bears, if you're bearish, your bias is to the downside. So you're looking for this breakdown. If you're bullish, then you're looking for a double bottom and you're looking for a rally off of it. It's pretty much that simple technically. 10-year Treasury yield. Let's get the latest here. 3.75%. So up 5 basis points. I've said recently, this needs to change. If the rates, because rates, again, are not going up because of a strengthening economy. If rates are going up, it's because of trying to build in a cushion for inflation. Now, I still think there's a long way to go if the bond market truly feels inflation's a problem. But for right now, you got a lot of folks getting out of bonds, which is sending the yields higher. And, you know, if you look at the correlation to the S&P 500, I mean, as rates go up, the S&P 500 has been coming down. When we had the break in the rates right here, latter half of June throughout July, it wasn't until we broke this channel in mid-August back to the upside. That's when the market, the S&P, started selling off again, mid-August. So as long as this stays in play, if I was bearish, which I'm not, but if I was bearish, I would say, you know, keep those rates moving up. And that's the best chance you're going to get for a breakdown in the S&P. The S&P 500 itself, let's take a look, because here was that June low. Actually, I do want that inspector. So the low close was 36.66.67. That was June 16th. The lowest intraday low was the next day on the 17th at 36.36.87. So essentially 36.66 closing low, 36.36 intraday low. On Friday, we went as low as 36.47 and we closed at 36.93. That is, in my view, a double bottom now. We have double bottomed. I back at this bottom, especially after we rallied, got back through both moving averages, went back and tested the 20 and broke out again. I said back then I didn't think we would see a double bottom. You know, at some point you're going to pull back, but I did not expect to see a double bottom. And yet here we are. Hey, the market continues to change. We have to change with it and address it. And so right now, this is the level. Technically, there's not a lot of earnings news coming out. We're going to talk about that. We don't have the jobs report for another couple of weeks. We're already now past the two big inflation reports. The Fed is met. So I think a lot of tension is going to focus on the technicals here over the next week to two. So I think it's a big deal whether or not 36.36 holds on an intraday basis and whether 36.66 holds on a closing basis. Because as I mentioned, the Dow has broken down, small caps have broken down. We've gotten two lower closes on both of those indices, lower intraday moves as well. So it's just a matter of having all of the indices break down. And so again, from a bearish perspective, that's what I would want to look for. I'd want to see that confirmation across all of the major indices. And if you're bullish, you want this to hold. The NASDAQ, well, this is the NASDAQ 100, but there's your low. And that was again back on June 16th. The low close, 11,127. On Friday, we got as low as 11,169. I still would call this a double bottom. I mean, maybe we go down and we test it fully. But when I look at a chart, when I see it's this close, to me, that's a double bottom. If you're a little bit shy of it, it's still a double bottom. If you go a little bit over, it's still a double bottom. So I think we have the double bottom in play. And so now, I mean, to me, everything is set in stone. We have a very, very critical resistance now. When you get a double bottom, that high in between the two bottoms is the high you want to look at, which was up at 13,667. It seems like we're a long way away, and we are, but it seemed like the bottom was a long way away about 5 weeks ago, and it's here. So just keep that number in mind. 13,667 on the NASDAQ 100 to the downside, 11,127. I think those are the lines in the sand for the bulls and the bears. All right. What I wanted to do now is go into the S&P 500. Many of you know I like to follow the sustainability ratios. And the most important time, I mean, I follow them intraday, but I've pointed out, I know I've pointed out to members, I've probably pointed out on the shows as well. But these ratios, I mean, obviously they're going to fluctuate day to day within a few days of each other, and certainly within, hour to hour. What I really find is most important are these intermediate to long-term signals that they trigger. So for instance, when we had the high back in December on the S&P and all of our ratios started moving down in December, it was just an indication that money was rotating out of aggressive areas and into more defensive areas. And when you're in a long-term bull market, you've gone up for 22 months, the most that you ever have for the last 72 years, and then you see things starting to turn defensive, you should at least have red flags going up. You should at least recognize red flags, even if you don't get bearish at that moment. When you get those red flags and then you start seeing breakdowns after it, there's your confirmation of the signals, the warning signs that you were seeing here. Now, as we've been going down all year, and this is mostly for those of you that are new, haven't been following, our program for a while. As you move down to these lows, what I look at is, are these ratios going to new lows? Because if they are, then to me, the move to the downside remains sustainable. As long as we were going up and these ratios were going up, then for the most part, I felt like the rally to the upside was sustainable. These ratios, as important as they are in my view, they're not more important than price support or price resistance. In other words, if the S&P 500 breaks down, respect it. I can sit here and say, well, the sustainability ratios look like this or that. But if we break down, we break down. Until we can rectify that breakdown, you've got to be, I don't know that you have to be bearish, but you certainly have to be cautious. Meaning, probably if you're on the long side, you get out. But as you look at these moves to the downside, each one of these S&P 500 moves where we set new lows before the bounce. So the final closing low before the bounce, if you look at where we were on every one of these ratios, essentially, we just kept going lower and lower and lower. So this is telling us that Wall Street continues to rotate, rotate, and rotate in a bad way. It's not good. Wall Street's giving us no signals the bottom is in. One of the reasons why I called a bottom back in June was as you hit that low, the ratios turned up. Now, what I want to point out is where we are now that we've gotten the double bottom. Where are we on these ratios? Have they broken down? Have they even gone back to where they were? And the answer is no. After going higher, all of them went higher off of this low, except maybe the transports, the last one. Yeah, that one was just kind of, it looks like it actually held. But that one's rolled over and has actually set a new low. That's the only one right now that has broken down below the lows that we saw over the summer. Every one of these other ratios, this is small cap growth versus small cap value, went down all the way through May, and then June, we saw it start to turn up. Now, we've been moving down for the last 2 months, but we're not down to where we were in June. So that's just, or in May. So that's just continuing to tell me that money is still rotating into growth versus value. Same thing at the mid-cap level. This is the mid-cap growth versus mid-cap value. You can see we're still well above that low. Large cap growth versus large cap value, still well above that low. This is the IWD. This is another way to look at the large cap growth versus value, still above. How about the XLY, XLP? This tells us discretionary versus staples. If we're getting ready to go into a horrible fourth quarter and a massive recession and the stock market's going to perform horribly, I would expect the XLY to be going down more than the XLP. Remember, Wall Street looks ahead. So if what it's seeing is really bad, this XLY should be doing what it was doing versus the XLP all the way through May. It should be continually setting new lows. It's not. Listen, I'm not making this up. Every one of these ratios, except for, this is the QQQ versus spider, but every one of them except for transports versus utilities, which is probably the one that has the least amount of positive correlation with the S&P 500. All these others are very positively correlated, especially the XLY, XLP. And that's why I like to use it so much, because this ratio, when it starts to move opposite the S&P, you need to pay attention, just like back in December. So listen, I have no crystal ball. I can't tell you the stock market's going to go higher. I can just tell you that I'm still not seeing anything different than I saw back in June. Money still is rotating away from these groups. Now, if we break down and all of these ratios roll over and set new lows, then to me, it's a completely different ball game. But rotation is favoring the bulls still. Another chart I wanted to show you, this was a chart I showed back in Market Vision 2022, back in January. Back then we were here, and these black arrows is what I suggested we were going to be looking at this year. I thought we were going to go down the first half of the year, back up second half of the year. So we went down, hit this line, which is kind of like this middle channel line, and you can see multiple tests. Anything where we pull back where it wasn't a major pullback, like here, financial crisis, here, the pandemic, where we had unbelievable fear. We went back down to those lows. Otherwise, since during this bull market, every other low coming down has bounced off the center line. Look at where we are right now. Double bottom, but we're right on this center line. I don't know if this is going to be it or if we go lower. Maybe, maybe this is going to be the time where we do go down. Maybe we hit this bottom trend line. That would be all the way down 3,000. Potentially. It's possible. I don't think it's happening, but it's possible. But watch this, because if we do break down, then all of a sudden this area or this line of support that is held many times throughout this bull market would begin to give way. That would be another feather in the bear's cap for sure. All right, equity only put call ratio. You know, I like to watch this for sentiment. Remember at the beginning of the year, sentiment was so bullish. It was the most bullish ever. It wasn't even close. And so that was another reason the market was so complacent that nobody believed the market could go lower. And that's when you got to be careful when Wall Street starts moving into defensive areas, because Wall Street wasn't telling everybody back then. Well, now look at what sentiment's doing. Sentiment, we had the equity only put call ratio go above 1 on Friday with that selling. And if you go back the last, we'll go back 5 years, the pandemic and the trade war got us to 1%. That was about it. The pandemic really had us shooting up for a period of time. But this is the only time, this has been 2.5 years. We had not had a single put call reading above 0.9 until Friday over the last 2.5 years. Now, the other thing I like to do is I like to change this to invisible. And then I like to pull up 5-day moving average. This is how you do it. Then I just get rid of this. I don't really care about any of this. Don't care about the volume. Actually, I will pull up the price on the S&P. And we'll do the 5 years. But what you need to understand is when we reach peaks right here, big market bottom. We reached a peak here, big market bottom. Reached a peak here, big market bottom. Peak here, big market bottom. That was June. That was June. That was just one more reason. We came up recently right here. We topped. We had a little bit of a bounce. It wasn't a huge one. But if you look through, most of these intermediate peaks also coincided with rallies. I'm just pointing out the big ones. But the reason I'm pointing this out is that if you go back here and look at the past data, you'll see that the last 3 days, well, Tuesday, Wednesday, and Thursday of last week, 0.67, 0.71, 0.83. Today's reading will wipe out this 0.54 from last Monday. So whatever we come up with today is going to wipe out that 0.54. And we're going to have 67, 71, 83, and 102, which is what I just showed you, plus whatever we have today. So let's say we have a 0.84 today. That's going to take the moving average, 5-day moving average, up 6 points, because 8.4 versus 5.4 is taking the total up 30. Divide that by 5 days, it's going to be 6. So let's go back. So if we get an 8.84 reading today, this will go up 6 from 0.75 to 0.81, right up again to where we were in June. So we've got sentiment again at an extreme as we hit this bottom from June. And we're coming out of the most bearish historical period at the close today. I don't know if all that's going to translate into a big move back to the upside. I'm just giving you some other things that you're not going to hear on CNBC. All right. Let's take a look at some earnings, and we'll do the earnings and the 3 you must see, wrap that all up together here. SNX, I'll just do a few of these. This is a company that will be reporting earnings, I believe, tomorrow. Double check me on that. But SNX is a computer hardware company. And you can see computer hardware actually near a 52-week low, or excuse me, 52-week high. And SNX has not been a great performer. It's actually near a 52-week low within the group. So I actually like to see how this stock performs, because if the group is strong, and this is one of the weaker stocks in the group, if they can somehow come out with a decent report, that's going to make me feel better about other stocks in the group that actually are showing relative strength, like Apple. We'll see. But SNX that report, even though I'm not really interested in that company, it does help me kind of understand a little bit better what to expect from some of these industry groups. So that's SNX. Let's see, next one. Tell you what, I'll do 3 more, and these will be the 3 you must see. I'm going to start out with JBL. AD line good. I mean, the action here has been mostly sideways, which if you've been following the market this year, that tells me without even looking that relative strength has to be somewhat decent. And here it is. It's near a 52-week high versus its peers. It just recently set a 52-week high versus the S&P 500, and its peers relative to the S&P have been rising. So unlike SNX, while SNX was in a decent group, it was a poor performer on a relative basis. JBL is in a nice group, and it is a strong performer. So this is a stock that I would expect to have really nice results coming this week. And I think this is going to be a mixed earnings season for sure. Not so much. I mean, I think most companies are going to beat, but I wouldn't be surprised if some lowered guidance based on what the Fed's trying to do. I think there are companies that probably have seen demand wane in the last 30 days. And I think we're going to hear about some of that when these earnings reports come out. All right. So that was the first of the 3 you must see. Let's do calm. That's what we're trying to do. Try to remain calm. Excellent performer. Cal-Maine Foods, AD line, great. Look at the stock breaking out the new highs. It's in the staples area. It's in food products, and it's one of the strongest stocks in food products. Another one that we've been giving to members as a possible trade candidate recently in our model trades was Smucker's, which is SJM. Looks very similar to this. Maybe not with the breakout, maybe not look quite as good. But I mean, here, near 52-week high, trying to set a little cup here. Look at the relative strength there. Beautiful. AD line strong. There are still pockets of strong companies. Unfortunately, some of them or most of them might be in defensive areas, but that just tells me to be, wait. We can still be aggressive from time to time, but save our capital. If I'm right and the market is bottoming and we're going to go higher, we're going to have lots of opportunities with aggressive stocks. I want to see some of those groups begin to move before I'm going to be more, much more behind them from a bullish perspective. All right, last one I'll give you here, then we'll look and see what's going on with the market. I think on Wednesday, we get Paychex, P-A-Y-X, a little bit bigger company. AD line, pretty good. Not too long ago, near a high, but we have pulled back quite a bit. Still, relative to software, Paychex one of the leaders. So this is going to be an important stock in the software group. If it comes through and does not perform well, that maybe won't bode so well for other software stocks as we move into earnings season. So that's what I'll be looking at. Anyhow, that's it. But let's take a look and see what's going on in the market as we open. Remember, this is the last day of the bearish historical period from July 17th close through September 26th. That is, I've got the numbers to show it. I know it doesn't have that fancy ring, go away in May. I always say, should we fly in July or something? I don't remember even what I came up with, but it's really mid-July. If you're going to go away, historically, again, the numbers will back me up on this. You go away July 17th and you come back on September 26th. Today is September 26th. We'll see. Anyway, looking at the market, we're just kind of mixed, a little bifurcated action. One thing that's interesting is the VIX. Even though it hasn't gotten up to 36, 37, 38, 39, which is where we were back in June, we did break out above 28. The VIX is high enough right here where if we fall below the June low and we start to see an acceleration, you have to respect it. I don't care how bullish you are. Because with a VIX in the 30s and a price breakdown, you can see impulsive selling and very, very quick and substantial losses. That's when the biggest drops occur, when the VIX is in the 30s or above and rising and you lose key support. So I'm giving you a lot of things to think about here. But one thing I wouldn't hesitate about is if the VIX keeps going up and we break down, and I'm talking about an S&P that's down below that 36 level, be very, very careful. We could see a big decline. I don't think it's going to happen, but those are signals that you don't ignore if you trade in the market. Anyway, that's all I got for today. Appreciate you tuning in. I'll be back tomorrow over at Stock Charts TV for the next Trading Places Live. That'll begin at 9 a.m. So all you have to do is at 9 a.m., click on Stock Charts TV. You don't have to be a member of Stock Charts. You can just click this, a free area of their website. So make sure you tune in for the next episode. This is going to be a big day. So I think tomorrow's episode will be really interesting. Anyhow, everybody have a great day. Happy trading.